Well, I have 7 o'clock on my computer, so I think we'll go ahead and get started. We've all got big days today and a lot to look forward to. So we'll go ahead and start this meeting off. And once again, we're grateful for your participation in this program, our grain and cotton marketing monthly update. And this month we have David Gibson with us as well from the Texas Corn Producers Board, and happy to have him. And so as we move forward, we just want to thank our sponsors, the Texas Sorghum Producers Board, the Texas Corn Producers Board, and the Cotton Board. So with that said, we're grateful for their support. And so as we move forward this morning, we'll start with Dr. Mark Welch, and he's going to give us some insight and update on what's going on with the grain markets.
Bobby, appreciate that. Good to be with y'all again this morning, and kind of bring an update of kind of where we were, where we left off last time, of some things that are going on in the corn market, and I think that are going to guide us perhaps of where this thing may be headed as we're wrapping up the corn growing season for the rest of the country here for 2022, and then obviously making our plans very soon for 2023. You know, the mantra this whole marketing year is based on, I think, summarized very well in this quote from a market analyst up in Indiana that this showed up in an email or a post somewhere back in March. He said, "This is the kind of year when we can't lose acres and we can't lose yield." You know, with this corn deal and the grain deal in general, it's been pretty tight for a couple of years now. And, you know, we were looking at a year this year to maybe get some more acres. We needed to yield, kind of get that, to ease that supply concern. And you can kind of look at these numbers, and we'll highlight a few of these on the WASDE report that came out in August. Well, we lost acres and we lost yield. And, you know, we never got a robust planted number this year. You know, our acres are down compared to last year. Then last year's yield was 177 bushels. That's kind of where USDA kind of had this year's crop pegged at the same as last year. Now we're down to 175.4. And I'm not convinced we're done in terms of their adjustments on the downside on the U.S. national corn yield. That was kind of, I think that August is kind of their first step in that direction. And so kind of we'll see where we head off. So that dropped production 146 million bushels. We did lower fuel use in the old crop year, and that gave us 20 million more bushels of carryover. Dropped feed use 25 million bushels this month. Dropped exports 25 million bushels. So, you know, there's a response on the consumption side as well with these relatively tight supplies and high prices, and that's exactly what you would expect. But overall, we saw the ending stocks number get tighter, and we're down with a stocks to use ratio down below 10%. That days of use carryover below 40. That's a tight world for the corn market, and that certainly seemed to be where we're staying. If you look at where this year's corn crop index, and that's you know, you take the percent rated very poor and fair and multiply it by factors, and you can create a line of a crop condition index this year, which is the black line, and you can see how it has been trending lower from 380 to start the season. Now we're down here about 347. The red dotted line, that would be your average index over going back to about 1980. The kind of the brownish line that follows that along, that was last year's corn crop index, which is very normal kind of year. And last year was virtually a trend line year. If this year were a trend line year, we would expect a yield of about 178 bushels. You can see the degree to which this year is falling well below last year, well below average. And now we're below 2019. Now, 2019 was a rough year. We got the crop in late. It was so wet across much of the Corn Belt. But our condition ratings this year are now at about the lowest levels they were back in 2019, when we ended up with a corn yield that year of 167 bushels, or about 3% below trend. So we're in that area, certainly below what would a normal kind of year. We got to finish this thing off strong, kind of hold the yields kind of where anticipated right now. But certainly I think we're in that territory that you might expect even a little more lower yield adjustment before this thing is over. World corn production, we mentioned that drop in the U.S., 146 million bushels this month. But it's interesting. it's interesting that with some these numbers got shifted a little bit. That's actually an increase in Ukraine of 197 million bushels this month. Things are looking a little better. The prospects of them making a crop, so kind of offset the difference. The big drop this year was this month was in European Union. It's hot and dry over there too, and USDA reduced the production estimate from Europe by 315 million bushels, and so that's a significant drop in our global production kind of numbers. And this just kind of is evidence of what happens when we have short crops and high prices. Per capita consumption goes down. And that's what we indicated by this red line. This is the per capita consumption of feed grains and food grains, barley, corn, millet, mixed grain, oats, rye, sorghum, and wheat. And so when we have these short crop years, those consumption levels go down. When we have short crop years combined with a slowdown in economic activity, that blue line is the average income in the developing and emerging economies of the world. And when their economies slow down and we have a drop in per capita consumption because of high prices and short crops, it can take 2, 3, even 4 years to get those consumption levels back up above where we left off. And this year seems to be shaping up kind of that way, depending on the degree to which the economic conditions that we struggle economically around the world, whether we go into a global recession or not, just the slowdown in that economic activity, the slowdown of the pace of economic growth can certainly have a long-term impact on our per capita grain consumption numbers. And so on that demand side, it may take us several seasons to get that demand back up where we left off. When it comes to harvested acres, again, we've been on these higher price paths for a couple of years now. And so even though this year's harvested acres are not actually down a little bit compared to last year, some 2 billion acres compared to, this is coarse grain, food grain, and oilseeds, a little bit lower than last year. Go back a couple of years, and we've added some 67 million acres for coarse grains, food grain, and soybeans. And that 67 million acres, that's like adding another Brazilian corn crop to the production base globally when it comes to food grain, feed grain, and soybeans. So that's kind of what economics would tell us. When you have high prices, it's going to bring more production capacity into the system, and that is not likely to go away. And so if we're moving forward, if the weather cooperates and other resource inputs are available, certainly that production base is expanding, and at a time in which we may be looking at a couple of years before we get the consumption rates back up where we left off. So again, if we're looking at factors that might dampen our price outlook moving forward, these are the kind of things that are working behind the scenes. And looking at that price relationship between the U.S. season average farm price for corn, and that would be over here on the y-axis, that's in dollars per bushel. And again, that's the national average price paid to all farmers during the marketing year, relative to the days of use on hand. So that's our stocks to use ratio. When you drop that days of use below 40, that's when we get up into these higher price years. And certainly 21 and 22 now are in that environment with these relatively tight supply to use situation that we have going on in the corn market. You know, for years and years, we'd go to meetings and people ask, what's going to take to get $5 corn? Well, you need to get that days of use on hand below 40. And starting, we'll be able to do that here in 21, back up here in 22, and we're looking at some pretty good pricing opportunities. I think the question before us now is, what does it take to get $4 corn? Well, to get back to $4 corn, get that days of use on hand back above 40, a 40-day supply. And if we were, again, to see combinations of yield, of area, and then obviously then with on the use side, all those factors can contribute to kind of push us back the other way. So I think that's kind of as we go month to month, are we moving closer? Which side of that 40-day threshold are we continuing to move? Are we moving further away from it to the left, or kind of coming back to that toward the right? And that, I think, guides my my price outlook of where we may be headed as we move into the next growing season. Again, it just kind of shows us where we've been. These are Texas cash prices for corn, grain, sorghum, and for wheat. and we record these prices on a weekly basis. So these are Thursday prices, which may not be the all-time high on the chart, but it kind of gives you an idea. And we're back now to pre-Russian invasion of Ukraine levels across the grain markets, but still looking at prices, relatively speaking, that are in an area that we don't trade very often, to still be looking at $8 wheat, corn $7.50, $7.60 a bushel, and even grain sorghum still above $6. That's a bushel price. So still some relatively high prices, even though we're maybe even a little below some peaks that we saw last year, but still well above harvest a year ago, and certainly with a longer perspective, still looking at some very favorable prices as we're wrapping up this season and starting to look ahead and make some plans then for 2023. And so I think several factors as we're looking at perhaps maybe we've gotten this season wrapped up. If we're looking at some management challenges and some strategies looking at next year, there may be some opportunities to start thinking about locking in fertilizer prices. They're down a little bit from where they were in the spring, not as low as they were a year ago in the fall. But if we're looking at maybe doing something on the input side and locking that in, what is the price, the output price that makes that input work? Certainly, we may have some residual fertilizer left this year on some short crop acres. But if we're looking at committing those inputs relative to what that output price that makes that work, the danger is we get the inputs locked in and then we see much lower harvest prices if we don't do something on the output side. So I think it's imperative that we take those risk management strategies and tools, price floor mechanisms that are out there to protect the downside as we're making commitments on that input, because there are factors that certainly could lead us to lower prices a year from now, even though the fundamentals are still strong. The factors are there to give us a boost in production and to still limit the growth on the consumption side. That's still the overlying price structure of our market right now. Obviously, Mother Nature and a lot of other factors have to contribute to have this all play out. But all things being equal, it would indicate that we would look for a larger supply on the feed grain markets a year from now, and on the growth side, on the consumption side, that may be much more of a challenge. So I keep that kind of in the back of our minds as we start building our budgets and making our plans and making those commitments then for 2023. What I brought to share this morning. Certainly appreciate any comments, follow up, phone calls, emails. Be glad to carry on the conversation here this morning or at any point as you have other issues and concerns come up. Again, appreciate the time, Bob. Thanks for having me on.
Oh, thank you for being with us this morning, and hope you enjoy the rest of your day. Greatly appreciate it. So as we're moving along into our next speaker, Dr. John Robinson, who's our state cotton marketing specialist. Again, we're glad he's on with us this morning, and I'll turn it over to him, and he can bring us his update.
Bob, I think I'm going to need you to load my presentation if you can. There we go.
All good?
It looks like it's in.
You got to hit play show.
Not in show mode.
Play show.
Down there at the bottom, that little icon.
Yeah, right there. That one. Mm-hmm.
There.
I hit it and did nothing happen.
There it goes.
Okay, that looks good. So thank you for letting me share some thoughts, even though I confess I don't come with a whole lot of explanations for what you're seeing on the screen. This is cotton, the cotton futures harvest time contract price, the December ICE cotton since January the 1st. And the first story is this nice steady upward march all the way through the spring and peaking at $1.30 32 something up there at the very top. That was May, the middle of May. And then from the middle of May to sometime in June, we had this inexplicable plunge. Part of that attributed anyway to, worries about demand, worries about what the previous high prices would do to demand, and then also worried about inward contraction of demand because of an oncoming recession. That was the explanation that was being offered. But that plunge in prices from top to bottom was 50 cents. And I'm here to tell you that such a price move is way out of the statistical realm. Nothing explains that. Speculative selling is the reason, but speculative selling, the amount of it doesn't explain that drop in prices. I still can't, and I haven't found an adequate explanation for why things fell 50 cents, particularly in the middle of the summer, particularly in the middle of a terrible, terrible summer, such as what we have because of the weather. Nevertheless, we've had the plunge, and then the happy part of this story is what you see at the tail end of that price chart. We've had a bounce, and as of the last time I looked, December 22 is trading at $1.16 something. I think, explain this bounce and why there was some recovery. First of all, there was no reason to fall as much as we fell down into the 80s. That was, there really wasn't a good reason for us to be at $1.30, and there wasn't a good reason for us to fall to 80 cents. So, we needed to recover from that, and we did. Bob, go ahead and flip to the next one, and I'll talk about the rationale for why we've seen some recovery. Can you flip it to the next slide?
Yeah, hopefully.
Well, the next slide is the summary in the last column there of supply and demand numbers that USDA put out for U.S. cotton in their August WASDE. And there was a pretty big surprise in these numbers. The surprise was in the quantity. Everybody knew that because of the drought, that USDA would come in and cut production. Everybody knew that. Everybody expected it. Nobody expected them to cut production 3 million bales, which is what they did. They did it by bumping up their assumed abandonment. They had abandonment previously. Their guesstimate was 31.5%, which is pretty historically high. That's 1 in 3 acres failing. Well, they bumped that up to 43%, and they lowered the yield, and the combination of fewer harvested acres and a lower yield was 3 million fewer bales of production, which is astounding. I mean, that's just in a monthly adjustment. I've never seen that huge of a monthly adjustment. And what makes it even more astounding is that it happened, the year's not over. There's still unfolding, there's still things left to happen. There's still a lot of uncertainty with the size of this crop and how tight the resulting ending stocks are going to be, which this is pretty tight. They took them below 2 million bales down there at the bottom. 1.8 million bales is historically it's in the top 10 lowest ending stocks ever. And it's tight. It just means that when we run out of cotton in about, next August, these are projecting the supply and demand numbers as of July 31 in 2023. They're basically, all the cotton will be committed. The pipeline will be, full with what's left, and there'll just be nothing left practically. That's what those numbers project. And it means that prices will be rationing what few available supplies will be there. So, having ending stocks that low because of having production that low, is an honest recipe for having, prices ration what's left. And so that's why prices should be bouncing around between $1.10 and $1.20. And I've been asked a lot, well, should we just hold on and wait? Should we let them climb up? I don't think they're going to, there's not a reason for prices just to march steadily higher and get back up to 130 and then go to 150 and then go towards $2. There's no reason for that to happen. We're not in a situation where demand is increasing. If anything, demand is kind of shaky. This is a supply shortage kind of problem. And, the market is already signaling that it thinks prices ought to be in this $1.10 to $1.20 range to cover the expected shortage that we're looking at right now. Now, still, things can still happen. We can have, and I don't wish this on anybody, but we can have tropical troubles, on the Texas coast, and we can have hurricanes float up into the Delta, or we can have hurricanes slam into Georgia. Things can happen to mess up the production picture on top of where we are right now. So we just have to see. It could get worse, and prices could get higher because of that. Maybe $1.15, $1.20 is the fair price. Or maybe it could go a little bit higher. If I was a grower with unpriced bales that I was pretty reliable, pretty certain I was going to harvest those bales, I wouldn't be just twiddling my thumbs where things are now. There was a huge lost opportunity when prices fell from $1.30 to 80 something. We've had kind of a gimme back with prices bouncing back up over $1 and bouncing up. They were reacting to this report. They were reacting to these numbers that happened last week. And like in 2 or 3 days, we've been limit up because of the shock of how much USDA cut. Well, that's an opportunity to be selling some scale up selling as it goes up. And if it starts to trend back down towards $1.10 or back towards $1, I'd be scaled down selling as that happen, some reliable portion of your expected harvest. I wouldn't be letting this opportunity slip if you let the previous one go already. Again, looking forward, there will be clarity in the cotton numbers. It's coming from the subsequent USDA reports that are coming before the September WASDE comes out. USDA NASS will have field sampling over the entire state of Texas and Mississippi and North Carolina and Arkansas as sample states. They go out, they count squares and bowls. They go back to those same fields, those same plots, and they recount them in October and they recount them in November. So we'll be getting better data in on, exactly, how much fruit load is out there and how much expected harvest. We'll also be getting more Jennings data, which has started already. So between the combination of Jennings and objective field sampling by NASS, we'll be getting better data, and the picture will get clearer. And as the picture gets clearer, then again, some of the jet fuel will kind of fade away out of this market, and we'll settle down into, just expected harvest time prices, which, if it's this tight, if it's 1.8 million bales of ending stocks, we could end the season with prices over $1. They could still slip 16 cents from where they are right now. So I would again suggest doing some action, some selling action or hedging action for where things are now. And unless somebody's got a question, Bob, I'll just leave it at that. I appreciate the opportunity again.
Dr. Robinson, and I know there's a lot of stuff happening in the ag markets, both grain and cotton. So it's a funny time. It's been a funny year.
Yeah, that it has.
So let me stop here, stop sharing. Okay, there's David Gibson. He did make it in.
Yeah,
How are you this morning?
doing well. Had to wrap up a radio program with the station up in the high plains and then zoom down to South Texas. So busy morning around here.
Yeah, well, it's kind of we as agents and the speakers and such, we've had a little bit of a challenge because we're all somewhere other than we're supposed to be right now. So it's kind of good to see you this morning. With that said, we got David Gibson, Executive Director, Texas Corn Producers Board, with us this morning, and grateful for his presence with us. And we'll turn it over to him, let him give us a little update on what's going on in the corn world.
Okay, well, it's good to be with y'all today. After hearing Mark talk and John talking about prices, I'm hearing from growers about it's a good thing prices are high because what we're producing is not near. We need all those prices to make our production even come close this year. Spent part of the week last week with Charles Ring from down in y'all's area. He's talking about his 30 bushel corn yields. Talked to another one that had some non-bushel yields. Talked to another one that never harvested. So prices have to be good. The cotton side, you know, our board's made up of corn growers, but they all grow a lot of cotton too. So the jump in the market was great, but most of them don't have near the acres or near the production that they would have expected. And I think that's what's driving those numbers. And, you know, sometimes we forget, we don't, you guys in the extension, you guys in the marketing side, the extension folks, don't forget that we have to have production in order for guys to survive on the farms. And this year, I guess John was talking about the big surprise in the acres. Of cotton, I really wonder, from living up here in the Lubbock area, traveling this area a lot, having been to South Texas, parts of Central Texas, I'm still wondering where the acres are, because right around where I live, I would say over half of the acres have been destroyed, and probably another 10% was never planted. So and then even what's out there, irrigated cotton is it's not going to produce the normal yields on the high plains just due to all of the heat. So the cotton deal's got a lot of run. The thing I see in the corn market up here, and I'd add to Mark, you know, he's got the prices kind of pegged. The thing that I'm hearing from growers in all areas is what the basis is doing. Had a grower in the Panhandle, Northern Panhandle, sold some delivered corn 2 weeks ago for 260 plus 260 basis. Some new contracts for $1.40 basis. Those type things are very unusual. When you travel around most of our state, our production is just down. The weather took its toll. That's going to be carry over into what happens this next spring and what we plant. It's hard to predict that right now. We've got rains predicted on the high plains for the next few days. If what they predict comes true, it'll be more rain in the next week than we've had in a year and a half. So we'll have to see how that goes. But it's very, very volatile as far as what the weather's done to production of corn and other crops statewide. One of the things Mark mentioned is our input prices. You know, we're hearing already that natural gas prices may stay up 2 to 3 times what they were over a year ago. That does somewhat impact our fertilizer prices, which are already high, not as high as they were at the beginning of the year. And as the study we worked with Texas A&M on, Ag and Food Policy Center, the high prices of the commodities going to drive the price of the fertilizer more now than what the natural gas does. But it still will all be factored in, and with the monopolies we have controlling our fertilizer industry, I'm expecting a lot of volatility in that market with a trend that it's going to be very expensive. So there again, that's going to be a added pressure on producers this fall, winter, next spring, as they're making those cropping decisions right along with these prices that Mark mentioned, the carryovers, everything that impacts it. So going to be a year that I think the growers and the bankers are going to sit with some real sharp pencils to try to figure out how to tie all of these loose ends together. One of the things I do want to mention this morning is on our website, texascorn.org, we have a link to the fixed comments to EPA pertaining to atrazine. If growers go in and look at this, EPA has come out in 2020, they said aquatic levels of concern at 15 parts per billion of runoff, of atrazine and runoff. They've come out in June of this year and lowered that to 3.4 parts per billion. And when we look at what that does for most of really all of the growing areas in Texas and about 90% of the corn acres in the US, that puts atrazine at a point, it's going to be hard for us to have that crop protection chemical survive and be able to maintain the label and be able to be used. It's the most widely used herbicide. You guys all know from your county programs and working with growers on weed control. If we don't use atrazine directly, we use it mixed in other products. There's about 90 products out there. I mean, between corn, sorghum, sugarcane, and multiple other crops, but primarily on corn, that contain atrazine. And what we're told, if we were to lose this appealing this level, that, you know, it could actually take atrazine off the market for some of our growers. It'll cause some of these other products to have to be reformulated, relabeled, and approved by EPA. And if we do that, you know, we could wind up with some serious shortages of chemistry to do weed control. So we're really encouraging the growers. I mean, it's not just Texas, this is belt-wide, to make comments to EPA. We want them to use the sound science, the science that's been developed over 20 years that shows that we do not have the problem that they're telling us we have. We had actual test sites in counties and scattered all over our state that were monitored by EPA back in about 2015 to 2018 that helped set those levels in 2020 at the 15 parts per billion level. And we had no concerns anywhere in our state. But if we move to the 3.4, we have concerns in several parts. It'll require many restrictions on growers to use the product. So on our website, there's two things. There's a petition. You can click on the petition site, go in and sign that. And then there's another submission point that puts your comments to EPA. What we're asking, and we're hoping that we have 50,000 producers from across the country submit comments about the importance of the atrazine, how they manage it, and how this would impact their farm economically, and also in the fact that they're wanting us to do more, to do less tillage, this climate smart stuff we're hearing they're putting out. If we lose our crop protection chemicals that allow us to reduce tillage, we're actually turning around and going right against what they're wanting us to do from an environmental aspect. So guys, you know, for your county programs, we'd really like you to push this, get growers to look at what it might do to them, see some of the new restrictions that are being laid out, and have them get online and make their comments. So those are just a couple of things I wanted to mention this morning, and I appreciate the opportunity to be on, and we're always open for questions. We have our directors down there in your area, Jim Shigerick over at Beeville, Daniel Berglund at Wharton, Colin Chopless and Charles Reen there in the Sinton area. And just, you know, the growers can contact any of them. They're usually, I know they go into a lot of the extension programs are there, and they do bring in the comments they hear from those growers as we formulate the things we work on here with the Texas Corn Producers Board.
David, I got a question. Do you happen to have in front of you when the comment period is over?
The comment period's been extended to October 6th.
Okay.
It was originally September 6th, and they've extended it 30 more days out into October. But, you know, everyone's really busy, and so we're trying to stay on it as people are, if they get rained out or if they finish harvest, so they can get on and make those comments.
Well, good, really good information. We'll try to move some of our producers forward on that. I'd say it is a very important tool we have in our weed control box. So just appreciate the information this morning. And Matt, do you have anything you want to bring to us? Have any comments?
No, sir. Thank you for hosting. Kind of off the beaten path today. We're in College Station for state staff conference. So we're headed straight from here to that. So thank y'all for being on this morning.
I was wondering what all the ties were for, guys.
That's it.
We're headed over to a big function today. So we were told to look nice.
It looks like Mark's out on the road.
I'm in Kansas City this morning. So got a little bit of a crop tour up in this part of the world, driving up and saw a wide variety of conditions. Some of that southern Missouri, it's dry and it's been hot. You get up a little further north, yesterday rainy and cool. You see some decent crop, but it's all over the board. Yeah, it's going to be kind of hard to get a number pegged for this year until we get the combines running. We're going to see everything.
Yeah, that's on our weekly calls with the other states. That's what everybody's seeing in their crop tours is a lot of the corn looking good from the road, but when they get in it, there's a lot of tip back, some poor pollination in some areas. It seems like at the end of the day, we come out with those yields around those trend lines, but this time looks like it's going to be real hard. Last week, I was actually in Western New York in an area there around Rochester that kind of, as I learned, is breadbasket of the East right there. And they were doing a crop tour and their yields, they had some excellent looking fields, but when you got out in the fields, they've probably got a 20% yield loss in that area just due to no rain and moisture. I mean, they're still looking at 170 bushel corn, but when they're used to making 200 or better on those, they called it gravel hills. I called them rocky hills. But it was interesting. Plus, we had some guys in from Iowa, and they were saying they were seeing the same thing in their part of Iowa, where the road tour looked much better than when he really got out and went through the field. So a lot of unknowns in what's going to happen, production wise.
It has been a very challenging year across the United States, I believe. So anyway, just again, thank y'all for being with us this morning and supporting our effort here. And I guess until we meet again next month, I guess we'll close this out.
Take care.
Thank you, Bob.
Sounds good. Thanks,
Y'all
everybody.
have a good day.